All right, let's break down Frontdoor's second quarter 2025 earnings. Now, on the surface, this quarter was an absolute home run. But the market's reaction, well, that told a completely different story. So we're going to dig in and figure out what was really going on.
So here it is. This is the central puzzle we need to solve today. The company reported fantastic results, they raised their guidance for the year, and yet the stock, after an initial pop, finished the day down almost 4%. So what on earth happened here?
Okay, first, let's look at the numbers that really should have sent this stock flying. On the bottom line, adjusted earnings per share came in at a $1.63. Now, that's not just a beat, that is a 13% beat over what analysts were expecting. I mean, what a fantastic start.
And that strength wasn't just in the earnings. Nope, the top line was just as impressive. Revenue hit $617 million. We're talking a powerful 14% jump from last year. And, yep, another clean beat against Wall Street's numbers.
But for me, this right here is the real showstopper, a gross margin of 58%. That's not just good, it's a company record. It's up 130 basis points from last year. This tells you they're running an incredibly efficient operation with real pricing power. So with a beat on earnings, a beat on revenue, and record margins, where did all this amazing growth come from?
So, how did they pull this off? Well, when you look under the hood, there are really two key stories that are driving these incredible numbers. The first big driver was the acquisition of 210 Home Buyers Warranty. And listen, this wasn't just some small add-on. It's turning out to be a totally transformative deal that's already paying off way faster than anyone thought possible. And the execution here is just, wow, it's really impressive. The integration is already way ahead of schedule. Management just raised its full-year cost synergy target by 50%, from $10 million up to $15 million. This deal isn't just adding a ton of volume, it's also diversifying their business into things like new home structural warranties, which makes the whole company much more resilient. But hey, this wasn't just a story about growing by buying another company. No way. Frontdoor's organic engine is also firing on all cylinders. Their direct-to-consumer channel, what we call DTC, showed just incredible strength. And you can really see the momentum building here, can't you? Q2 was the fourth quarter in a row of organic growth in the DTC home warranty business. It came in at a really powerful 9%. Now, this is so crucial because it shows that the core brand is resonating directly with customers, all thanks to smarter marketing and a much more refined strategy. But wait, there's more. Frontdoor isn't just winning in its core warranty business. They're also building up some powerful new revenue streams on the side. Just take a look at their other revenue category. It absolutely exploded, growing 63% compared to last year. And this was no fluke. It was powered by this trio of high-growth initiatives, their new HVAC installation program, the smart water offerings with Moen, and, of course, that structural warranty business that came along with the 210 deal. On that HVAC program in particular, it's a runaway success. Management raised its full-year revenue outlook for this program for a second time. They're now expecting it to bring in $120 million. That's almost a 40% increase from last year's results. And get this, they say they've still only penetrated less than 2% of their member base. That signals a massive, massive runway for future growth. So let's just recap for a second. Record margins, a monster beat on earnings, an acquisition that's outperforming, and new growth engines that are firing. This brings us right back to our central question. With a story this strong, what could possibly explain the market's negative reaction? And the puzzle only gets deeper when you look at the company's own outlook. Management didn't just meet expectations. They raised their full-year guidance on everything. Revenue, adjusted EBITDA, and even their gross margin forecast were all revised upward. That's a huge signal of confidence in how the second half of the year is going to play out. This timeline really tells the whole story of the day. In pre-market trading, the stock was set to open up over 11%. But as the day went on, all that enthusiasm just completely evaporated. The stock did a total U-turn and closed down nearly 4% on exceptionally heavy trading volume. So here's the solution to our puzzle, and it has nothing to do with how the company performed. The drop seems to be a purely technical move. Basically, investors who'd been riding the stock up for a while decided to take some profits off the table once the good news was officially out. There were no new fundamental flaws in this story whatsoever. So, given this big disconnect between the company's fundamentals and the stock price, what's the play from here? What's our next call? Well, our core thesis is pretty simple. The market totally misread a very strong report. This negative price action looks like a classic overreaction driven by short-term trading, which, could create a really interesting opportunity for investors who are focused on the actual business. So, the key thing to watch for in the next few quarters is going to be their ability to keep those margins high and continue pulling out those cost savings from the 210 acquisition. If Frontdoor can maintain these record-level margins and keep over-delivering on those synergies, the market is going to be forced to recognize the fundamental strength here.
So, based on this robust performance and the really successful integration, our verdict is outperform. The company is executing beautifully, and the long-term growth story is completely intact. The only question left is, how long will it take for the rest of the market to catch on?
That's all for this breakdown. And just a quick reminder, of course, this presentation is for informational purposes only and is not financial advice.